I want you to picture something for a second. It's a Tuesday morning. You wake up, make your coffee, open your phone, and the first thing you see is a notification that stops you cold. The market just dropped 4% overnight. Your portfolio is down thousands of dollars. And somewhere in the back of your mind, a question starts burning that nobody around you seems able to answer properly. Where did that money actually go? Not the news anchor's version of the answer, not the recycled social media post. The real answer, the one that actually changes how you think, how you react, and, if you stay with me until the very end of this video, possibly how you approach every single market downturn you ever face again. Because here's what I've noticed after years of studying how markets move and how people respond to them. The investors who consistently come out ahead aren't necessarily smarter. They aren't working with secret information. The one thing that separates them is this. They understood something early that most people never figure out on their own. And today, I'm going to walk you through it completely. So let's start with the question everybody asks, but almost nobody answers honestly. When a market crash wipes out, say, $2 trillion in a single week, where does that money go? The instinctive answer is that it vanishes. It burns. It ceases to exist. And I understand why it feels that way. Because when you look at your account balance and the number is significantly lower than it was last month, your brain registers that as a real, concrete loss. Something was there. Now it isn't. But here's the thing. That feeling, as real as it is based on a misunderstanding of what the stock market actually is. And correcting that misunderstanding is the first step toward thinking about crashes in a completely different way. The stock market is not a storage facility for your money. It's a continuous, real-time negotiation between buyers and sellers about what things are worth right now. Every share price you see on a screen is not a fixed value. It's the latest agreed price between the last person who wanted to sell and the last person who was willing to buy. That's it. The moment that agreement shifts, because sentiment shifts, because fear enters the room, because a headline lands badly, the price adjusts. And when prices across millions of shares adjust downward simultaneously, the total calculated value of the market drops, sometimes by staggering amounts. But no money was physically moved out of the system. What changed was the collective opinion of what things are worth today versus what they were worth yesterday. Think about a painting at auction. If nobody bids, the painting doesn't suddenly become worthless. It just means nobody in that room on that day agreed on its value. The painting is still the painting. Now here is where the story gets genuinely interesting. And this is the part I want you to pay close attention to, because most people stop too early in their thinking and miss it entirely. If the money didn't disappear, the natural next question is, who actually gets hurt? And the answer is both simpler and more instructive than you'd expect. In a market downturn, the people who experience real, permanent financial loss are almost exclusively the people who sell. Not the people who hold, not the people who stay patient, the ones who sell. Here's why that matters so much. When you own a stock and its price falls, what you have is what's called a paper loss. It exists only as a number on a screen. Your actual position, your actual ownership stake in that company, hasn't changed. You still own exactly what you owned before the crash. The only moment the paper loss becomes a real loss is the moment you decide to sell at the lower price. That's the transaction that makes it permanent. And here is the part that should genuinely shift your perspective. Every sale requires a buyer. For every person selling in a panic at a depressed price, there is someone on the other side of that trade. Someone calm, someone who did their research, someone who had been patiently waiting for prices to fall, who just acquired that position at a significant discount. This is what economists and market historians refer to as wealth transfer, not destruction. Transfer. Crashes don't eliminate wealth from the system at a macro level. They redistribute it, consistently, predictably, from reactive sellers to disciplined, patient participants. The 2008 financial crisis is the most documented example of this in modern history. The S&P 500 fell approximately 57% from its 2007 peak to its trough in March 2009. The scale of panic was extraordinary. Lehman Brothers had collapsed. Major banks were being rescued by governments. And if you had an investment account at that time, looking at your balance felt genuinely devastating. For many people who sold during that period, the loss was real and permanent. They locked it in. But here's what the data shows happened next. From March 2009, the lowest point of that crash, the S&P 500 went on to deliver returns exceeding 400% over the following 11 years. The people who held through the collapse, or who found a way to continue investing steadily during it, didn't just recover, they compounded significantly. The wealth that transferred away from panic sellers in 2008 and 2009 didn't disappear from the financial system. It showed up in the portfolios of people who understood the mechanism and responded with patience rather than fear. The COVID crash of March 2020 reinforced this with remarkable speed. In just 33 days, the market fell 34%, the fastest decline of that magnitude ever recorded. The fear was visceral and completely understandable. And then, within 5 months, the market had fully recovered and continued climbing. The crash looked catastrophic in the moment. In hindsight, it was one of the most compressed wealth transfer events in recent memory. Now, I want to explain one more thing before we get to the takeaway, because this piece of the puzzle is what makes crashes feel so much more violent than the underlying reality should suggest. It's a mechanism called forced selling. Most retail investors, when they sell during a crash, are selling by choice. Emotional, fear-driven choice, but still a choice. There's a whole other category of seller who has no choice at all. Large institutional players, hedge funds, leveraged traders, often borrow heavily to amplify the size of their positions. When prices fall sharply, their lenders issue what is known as a margin call, demanding more collateral or immediate repayment. The fund is legally obligated to sell assets immediately, regardless of price. That wave of forced, non-discretionary selling pushes prices down further, which triggers more margin calls, which causes more forced selling. The loop accelerates. Liquidity, meaning the availability of willing buyers, temporarily dries up. And for a period, the market feels genuinely broken. But what's actually happening during those moments is that prices are overshooting to the downside, well beyond what the underlying fundamentals of businesses would justify. History repeatedly shows that this overshoot corrects. Not always immediately, not always linearly, but consistently over time. The price of productive companies reflects the value of what those companies actually do, not the fear level of the people trading their shares on a given Tuesday morning. So here is the real takeaway. And I want to be completely honest with you about what this means and what it doesn't mean. Understanding that crashes are wealth transfers rather than wealth destruction does not mean every stock recovers. Individual companies fail. Sectors decline permanently. Risk is real and always present, and nothing in this video is financial advice. Every situation is different, and every person's circumstances matter. What it does mean is this: the number you see on your screen during a market downturn is not your wealth. It's today's auction price. Your wealth, in the context of long-term, patient, informed participation in markets, is determined not by what the market does on its worst days, but by what you decide to do on those days. Selling in panic has historically meant transferring your position to someone with more patience. Holding with understanding has historically meant receiving the positions that others gave away in fear. The next time that notification lands on your phone and the charts are red and the headlines are alarming, pause for one moment before you do anything. Ask yourself what you actually know about this moment versus what you're feeling about it. That pause, honestly, might be the most valuable financial habit you ever build. If this gave you a clearer picture of how markets actually work, share it with someone who needs to hear it, a friend, a partner, anyone who has ever made a financial decision based purely on fear. And leave a comment below telling me where in the world you're watching from and what moment in market history changed the way you think about investing. I read every single one, and those conversations are what make a community like this genuinely worth being part of.